warm welcome to the 7th Annual General Meeting of Smithson Investment Trust plc. I'm Mike Balfour, Chairman of the company, and I'm joined by my fellow directors up here, Diana Dyer-Bartlett, Denise Hadgill, and Jeremy Attard-Moshe at the end here. We have Simon Barnard down here at the front, and he will shortly be presenting to you. It's now 1 p.m, it's slightly after 1 p.m, and therefore confirm that the meeting has been properly convened and a quorum of shareholders is present. Thank you all for coming.
Hello everyone, thanks for joining us again. My name is Simon Barnard, I'm the Investment Manager of the Smithson Investment Trust. I'm going to start off with just a quick update on our team, then I'm going to go into the presentation. So first of all, we had a new joiner to the team. He joined in October of last year. In November, Will Morgan departed from the trust, and we have just signed a new person to join us in the US. So for the first time, we're going up to 4 members of the team. We will have 2 members in the UK and 2 members in the US, and I'm happy to take questions on that at the end. Right, let's go into the presentation. So I wanted to do something slightly different today, which is primarily remind us, why we all hold Smithson Investment Trust before going into the usual matters of performance and attribution. But what I wanted to say is the most short summary of why we own the Smithson Investment Trust is because we make money buying small companies that are going to become big companies. It's as simple as that. We are looking for great companies that will compound in value over time to become great, large companies. And here's a little more detail on that. We provide you access to a concentrated portfolio of the world's best compounding small companies. Now, there are a few elements of that statement which are fairly unique to the Smithson Investment Trust. Now, there are many small cap managers are out there, but I would say almost all of them, and I actually haven't found an exception, who invest in smaller companies tend to have a very long list of holdings, mostly over 100. We have a very concentrated portfolio, in contrast, of around 30 names. And the way that we can do that is because we only look for the world's best small companies. And that means when we find companies in which we have strong conviction for their future prospects, we can build a very concentrated portfolio around those. And finally, obviously, we want to let those companies do the compounding over time so that those small companies we have found grow to eventually become large companies. Now, why do we think this is a good idea? Well, some words from the master himself, Warren Buffett, who says, first of all, I like to put meaningful amounts of money in a few things. Now, Warren Buffett, when he started out, had a very concentrated portfolio, and that is always what he has been a proponent of. But second, Warren Buffett does tend to bemoan the fact that his group has become so large that he now has to do very large deals to move the needle on progressing that group forward. And so when asked in his Q&A, what would you do differently if you didn't have that handicap? He said, well, potentially it may be that the elephants that he has to buy for Berkshire Hathaway are not as attractive as the mosquitoes. He said several times he would focus on smaller companies. But it's not just small companies that we buy very good companies. Now, what do we mean by good companies? We mean companies that have strong competitive advantages in exciting niches which are growing. So that means these companies exhibit strong operating margins, they exhibit high returns on invested capital, and most importantly, they are very efficient at converting those earnings into cash. But of course, the most important thing amongst all of that is growth. For these smaller companies to become large companies, they need to grow at a high rate for a long time, and that is what we're looking for. The second point is, we told you we make money by buying small companies that become large companies. Now, you don't make much money if you pay the wrong price. In fact, great companies can be rotten investments if you don't pay the right price. So the second element of our simple strategy is to make sure we don't overpay for these companies. Obviously, great companies are quite obviously great companies to many people, and so they will never be cheap, or I should say very rarely be cheap. So they're never going to be lowly rated, but it is paramount that we don't overpay for these companies. And then finally, we want to do as little as possible. Once we have found, researched, and bought these fantastic companies, we want to let them do the work, compounding value over time, and try to interfere with that as little as possible. Now, it does require some activity, because small companies do change, and we may not always get it right, and in those times, we have to take action. Also, sometimes we find that the management teams, particularly founder-led, that have a lot of power within their small company, do tend to take those companies on occasion in the wrong direction. Again, we have to take action. So it's not simply the case of buying and forgetting, but we still want to do as little as possible. So how do we prove to you that we're still buying good companies? As usual, we have summarized this by amalgamating all of the company metrics into single individual metrics across these lines. So the blue bubbles are the average for the companies held within the Smithson Investment Trust, and for context, we have placed those against the MSCI Global SMID Index, our reference index. So first of all, number one, our companies are certainly high quality. You can see by the return on invested capital, on average for our companies, is 26%. That is a high number. And you can tell it's a high number because the average in the index is 8%. Now, that actually isn't the true weighted average of our portfolio, because we've had to exclude one company whose returns were so high that they skewed the average to a degree to which I felt it wasn't representative. But the rest, an average of the rest is 26%. Now, second, the important thing for many of our companies is that they also have high gross margins. Now, that has been key over the last few years with increased inflation, and I'll explain in a moment, but now even more pertinent in a world of increasing tariffs. Now, that is because our companies with high gross margins find it easier to either absorb or typically pass on tariffs when they come their way. Just to explain what this means, a gross margin of 62% means that our companies will make something for 38%, let's call it, or 38, and sell it for 100. So all the raw materials cost 38, the end price of the product is 100. If you compare that to the index of 30, the companies in the index are still selling products for 100, but it costs them 70 to make. Their cost base is more than twice as big as ours. So that means when inflation comes along, or when tariffs come along for their input costs, they will suffer twice as much as our companies because their cost base is twice as big. Or if we flip it on the other side, bearing in mind that our companies have strong competitive advantages, our companies only have to put up price by a small amount to cover the additional cost, whereas the companies in the index have to put their price up, if they can, by a far greater amount. Therefore, in an inflationary world or a tariff world, our companies are better positioned. This obviously feeds to a much higher operating profit margin than the index, but as I said earlier, a key metric we look out for is cash conversion. And you can see here that once again, our companies are converting cash at over 100% of earnings, and that is in comparison to the index at 80%. But finally, our companies are doing all of this with very little financing risk. On average, our companies are net cash, which means that we couldn't put a leverage metric in here because it wouldn't make any sense. So instead, we chose interest cover, but even that, by the comparison to the tiny dot of the interest cover in the index, you can see that our companies are very conservatively financed. So how do we do this day to day? Well, myself and my team are constantly searching and adding companies to what we call our investable universe. This is the long list, 92 names at the end of last year, from which we choose the portfolio. But of course, we don't own 92 companies. We have a concentrated portfolio of 32 companies. So how do we get there? Well, the 92 companies are all the ones that we have found in the world, bear in mind we look at all global markets, developed global markets, that we have found that are good enough to one they own that meet our very strict and demanding criteria for good companies. But we get from that 92 to the 32 in several different ways, primarily valuation. I said we don't want to overpay, so what you'll tend to find is the companies in the 92 are made up of companies which we would love to own one day, but are simply too expensive for us today. There are also companies in that list that are potentially at the wrong part of their business cycle. We don't tend to own many cyclical companies, but there are a handful. And it doesn't make much sense to be buying a company either at the top of its business cycle or one that is declining into the trough of its business cycle. Of course, in a perfect world, what we would do is buy it right at the bottom of the business cycle, but that is almost impossible. So what we tend to do is wait until it is at least improving its business cycle when we look at those types of cyclical companies. But another favorite way of getting hold of these companies is by taking advantage of what we call glitches in individual companies. So this is certain occasions where individual companies go through a short-term issue that we see could correct itself in an otherwise high-quality company. So one example would be Equifax. This is a company, a US-based consumer credit bureau, consumer credit company, that in 2017 suffered an enormous cyber attack, which caused it to leak millions of consumer records. Now, we came to the conclusion that this, while quite bad, was fixable, and even determined that over the next few years they were likely to invest so much in cybersecurity they may well become the most cyber-secure consumer credit company. And so it turned out to be. We invested in those shares in 2018 when they were at a low ebb post this incident, and have become a very strong performer for us over time, as that issue was not only corrected, but the company continued to go from strength to strength. Excuse me. And then finally, there are occasions, as we all know, particularly living through one right now, where a market dislocation causes many companies to be thrown out with the bathwater. We've given a few examples there. For example, in the middle of COVID, we bought Rationale. This is a professional oven manufacturer based in Germany. This is a fantastic company. It produces what is, practically speaking, the reference oven for professional chefs. It is the oven that everybody wants. They have one in the White House, they have one in Buckingham Palace, but it is the oven that professional chefs want to buy. So when better to buy a professional oven manufacturer than when every restaurant in the world is closed? And we discovered that we bought that at a very opportune moment, around March, April 2020, at around 400 euros. It is now over 700 euros, as clearly that company's market has recovered. And then actually in 2023, we bought another company that suffered cyber attack, almost a repeat of the playbook of Equifax, and that is Clorox. So in the autumn of 2023, Clorox suffered a cyber attack which shut down all of its operations. Now, this is a consumer staples company shipping many products to large supermarkets. So when your operations are shut down, it is an enormous problem. They were picking, packing, and sending products to supermarkets by hand. Clearly, that caused the share price to have a significant reaction, down around 30 to 40%. We again took the opportunity to buy, and it has subsequently recovered. So here is our current exposure. Now, I've put on this several names and logos of companies, all of which are owned by the Smithson Investment Trust. Now, I would invite you to shout out, I'll ask in a moment, but first I'll just make another comment on tariffs, which is, we are broadly speaking not particularly exposed within Smithson Investment Trust to the US tariffs. The reason for that are several-fold. Number one, the fortunate thing about smaller companies is that they tend to be either more domestically or more niche focused. So primarily speaking, many of our companies dealing in the US are based in the US, or if they're not based in the US, they don't tend to be dealing with the US. But we do have a couple of exceptions. So one exception is Fisher & Paykel. So this is a New Zealand-based company, and they sell breathing equipment to hospitals and sleep apnea masks to consumers. Now, they do sell in the US, but for their US sales, they primarily produce in Mexico. And fortunately, because of the medical nature of their devices, they are covered under the USMCA agreement, which is the old NAFTA agreement, and so subject to zero tariffs. The other major exception is Ambu. This too is a company based in, this time based in Europe, and they sell about 50% of their products in the US, but around 50% of that production is in Malaysia. The rest is done in Mexico and elsewhere. Again, they are covered by the USMCA agreement, but Malaysia is not. So that is their one issue where they are not covered. And so currently, all countries, as we know, have got a 90-day reprieve on a 10% standard tariff. That is what they are currently suffering from Malaysia, but that will go to 24% after 90 days if no agreement is reached. So that is the company we are looking at closely. The irony of this is that they are looking to shift, in the current environment, Malaysian production into Mexico because it is covered by that USMCA. They are not looking to shift it into the US. So are there any other companies on that slide that anyone would like to hear about? I'll just go through a couple if someone would like to shout them out. I can repeat them. Halma. So Halma is a UK-based industrial company. It is what we call one of our serial acquirers. So we have several of these. Diploma is another good example. We also have some elsewhere. And these companies supplement their organic growth, which, given they are industrial companies, tend not to be overly exciting. So, for example, Halma's organic growth is in the low to mid single digits. Actually, so is Diploma's in the mid 5, 6, 7% organic growth. But what we do find exciting is that they supplement that organic growth with constant small bolt-on acquisitions. And the way they're able to do this is because they are run in a very diversified nature. So Halma has a very small head office from which it administrates many subsidiaries, and each one of those subsidiaries have their own MD responsible for their own business and responsible for finding their own M&A targets. So through this method of management, it means that these companies can grow almost ad infinitum without head office management supervision, such that that growth can keep compounding and compounding. So the overall revenue growth of Halma tends to be in the low double digits and compound over time. Now, this is exciting for us because ultimately there's only two ways to grow: volume and price. Price always has a limit because you can't start gouging your customers, and organic growth in volume will tend to be tied to industrial production. But this is one way that these companies have found to continually, constantly grow their volume without reaching those ceilings. Right. Let's go to valuation. So here we have laid out the valuation of the trust over time since our inception in 2018. You can see that the current free cash flow yield of the trust, the top line, at 3.3%, is broadly speaking in the middle of the range that you've seen since inception. But I would point out a couple of things. Number one, that is backward looking. So when you start to compare that 3.3% yield to other things you see in the market, including government bonds above 4%, or other companies that are trading perhaps at a higher free cash flow yield, you should bear in mind that this is backward looking, so you cannot compare that in an apples to apples way. In fact, bear in mind that our companies grow on average throughout this period at around 15% in free cash flow terms. Then you can easily add that onto that free cash flow yield looking forwards, and so you're now approaching a 4% free cash flow yield, which is perhaps more comparable to other things you see in the market. And then the final point, and I'm sure we'll be talking about discounts in due course, and something that we certainly don't welcome and want to close as soon as possible, but at this current moment, you can buy this portfolio at a 10, 11, 12% discount, so that 4% free cash flow yield is probably more like 4.4. So actually, when you start comparing what we own in Smithson compared to other things in the market, it is looking increasingly favorable. The reason for that is that over the last few years, small and mid caps have underperformed large caps. Now, previously, the end of the last cycle was in 2000, so that is when the small caps were at their low ebb relative to large cap, which obviously makes a lot of sense given the dot-com boom. There was then a fantastic run of 16, 17 years post that as small caps outperformed large caps. But just in the last 7 years, we have seen that cycle turn over and have seen a continual decline in relative terms of small caps versus large caps, which have meant that as of today, the valuation of small and mid caps relative to large caps is also at very low levels. So we see below this line, small and mid caps are at a discount to large caps, and you can see that once more they are almost approaching the low levels that they last attained in 2000. Going on to what we have been doing, we try to do as little as possible, but this is what we have been doing. With the background of small and mid caps at a low ebb with low valuations, you can quite imagine that we've been quite excited in that environment to pick up these companies in the 92 long list that we have been waiting to buy over time. And so 2024 was actually quite a busy year for us in buying new names. We were funding that through a series of sales, some which had done extremely well, like Technology One. So this is a company which we've owned since inception. It was up over 5 times during our ownership and had reached a valuation which we could simply no longer justify, and that is why it was sold towards the end of last year. Another of a similar ilk was Fortinet. Back at the start I said we're trying to buy small companies that become large companies. Fortinet was up over 4 times since we owned it, and that had indeed become a very large company. So it reached to around $70 billion of market cap, and we came to the conclusion that it no longer fit within our small cap, mid cap strategy. And then I'll just touch on a couple of the new buys that we've done so far in 2025. Doximity is a professional network for doctors in the US. So this is a network where doctors sign up using their medical credentials, and immediately the company knows everything about that professional. They know what they have published, they know their specialty, and most importantly, they know what they're interested in. So when they provide them a feed, just like LinkedIn for other professionals, they can specifically target that professional, which, as you might imagine, is extremely valuable for advertisers. So clearly it is an advertising-based model, but the important thing for Doximity is they only serve 1 advert per advertiser to each doctor a month. So there is an enormous inventory of potential advertising that they can continue to sell to, via the network, which tells us that there is a very long runway of growth ahead. I may perhaps also touch on the sale of Fevertree, because this is a long-held company that we bought in 2019, and we eventually sold, actually primarily stimulated by the deal that they did with Molson Coors. So over the last couple of years, when Fevertree had been struggling, particularly in their UK business, they had been growing very well in the US business, and what kept us holding onto the position was that the current profitability in the US was extremely low, possibly break even, but the growth in that market meant that one day it was going to become their largest market. It now has become, and subsequently would become very profitable for them. So we would then have a large, profitable, fast-growing market. They signed this deal with Molson Coors toward the end of last year, which had 2 effects. Number one, it had a big spike up in the share price, but second, reading through the details of that agreement, they actually signed away half of the future profits of the US business to Molson Coors. So for us, we saw on the one hand the share price going up by quite a bit, on the other hand a lot of the upside that we were counting on having been signed away to a third party. So that eventually led us to the decision to sell. Now let's touch on performance. In 2024, performance was disappointing relative to the index. The NAV was up 2%, not the end of the world, but the reference index was up 11.5%, which meant that in context our performance was disappointing. Fortunately, year to date, we have started to outperform again, which means that, of course, since inception, we are still ahead of the index. And I can say that as bumpy as April has been, month to date, we are still outperforming in April and therefore in the year as a whole. Obviously, things change day by day, so that may change, but so far, so good. It's not good that performance is negative, but at least we are surviving in that environment. We have also laid out the chart below, which is in reference to our peers, and again you can see that since inception we have outperformed our peers. A breakdown of that performance is given here, where you can see on the right hand side our contributors and detractors. You can see Fortinet there at the top, which has done extremely well, Fisher & Paykel, which we've already mentioned, and Technology One as well. AdTech and Diploma are two other serial acquirers that we own. Actually, AdTech we sold towards the start of this year, again having done extremely well and reaching a multiple, funnily enough, double that of Diploma, so we decided to stick with Diploma and sell AdTech. On the detractors, we've got several here. Temenos was a software company selling to banks. This was a company where we feel management had mis-executed on its transition to a software as a service model, and upon the management being removed, we decided and realized that to turn that business around would require very heavy subsequent investment, so we decided to sell that business and redeploy the capital elsewhere. Domino's Pizza Enterprises is a similar example. Management made certain missteps in some markets, including Japan and Germany, and again the management was removed and it became apparent that the problem was even bigger than we thought, so we again sold that position. Fevertree I've already mentioned. Finally, the number one question you should always ask someone who is standing in front of you offering an investment proposal is, do you own it? Well, I decided to share with you my personal investment portfolio to demonstrate that I do indeed own a lot of Smithson. So this is my personal portfolio, over 70% of which is allocated to Smithson. And in case you fear that this is a portfolio of only a few £100s, I can disclose that that Smithson holding is worth more than the value of my home. So I'll just leave you with this wonderful quote from Nassim Nicholas Taleb. If you don't know him, he's an ex-portfolio manager turned author. I can recommend any one of his books. He's written several. But he says, don't tell me what you think, tell me what you have in your portfolio. This is my portfolio.